Well, folks, we are witnessing something happen with stocks that we have not seen since the great financial crisis of 2008-2009. Dividend stocks are getting obliterated out there as consumer staple stocks. Some of the businesses that would be seen as the safest companies in the world, they're getting absolutely trounced, and they did again here today, okay? We're going to go through that, talk about that. I bought some stocks here today. We're going to talk about what stocks I bought, why I bought those stocks here today. We're going to talk about some hedging opportunities. Let's call it a little portfolio insurance. We're going to discuss that in this video and a few other subjects. So busy video, action-packed. I appreciate everybody joining me as always. Thank you so much for being here, folks. Thank you for being subscribed to the channel. And let's just start getting through this, okay? So right off the bat, Kraft Heinz was down over 5 percentage points here today. Now, Kraft Heinz being down 5%, that is the equivalent of Tesla being down 10%, 12% in a day, right? To be quite frank, a shocking number. And for no reason, just 5%. You know, like this is these stocks day after day after day after day. It's not like they announce earnings. It's not like any big news came out that's affecting those stocks. It's just down and down and down, right? It's a slaughterhouse. And it just continues for all these big brand name companies that are in the, let's just call it non-tech space, right? Look at Monster. Monster took over a 4% hit here today. This stock was $58 a share 2 months ago. 2 months ago, $58 a share. It's down to $47. And the scariest part of these consumer staple type stocks all falling is the how rapidly it's happening. I think it was one that's scary because these stocks don't just drop 15, 20, 30% like in a snap of fingers like that. A high growth tech stock, you could understand that. But these sorts of stocks, this is not normal, folks. This is the first thing from normal. We haven't seen this since like 2008, 2009 in regards to these type of stocks. This is a scary downdraft. And you got to ask yourself, like, well, where are we going here, okay? Because there's absolutely no signs of a bottom here. Campbell's Flippin' Flapjack and Soup is now down over 33%, down another 3.5 percentage points just today, right? Like I told you guys at the top, a Campbell's Soup being down 33%, that's like Tesla being down like 65% in a year, which is honestly what we saw last year with those tech stocks, right? This is incredible falls for these sorts of companies. You never would have predicted this. JM Smuckers, are we talking jam or are we talking jelly? Look at this one, 31.4%. And you got to ask yourself, where's the bottom for these stocks? Because they're showing no signs of a bottom. It's not like it's starting to kind of even out a little bit and you're like, ooh, okay, it looks like the worst is over and we're kind of bottoming this thing out. These things are in complete free fall. This is the definition of catching a falling knife. By the way, do you want to know my quick opinion on catching a falling knife in regards to stocks? It's a famous expression, catching a falling knife. I like to catch falling knives. I really do, okay? It doesn't mean you have to, and it is a dangerous place to play. I can tell you that it's a dangerous place to play. But the reason I'm willing to catch falling knives is because not all stocks have a long bottoming out process. Some do, but some just have a straight V recovery. So if it's something I really like, I'm not scared to step in there and catch the falling knife. And are my hands going to get sliced? Heck yeah. Did they get sliced a lot last year? Heck yeah. But I'm willing to take that risk, right? PepsiCo, $190 just back on July 23rd, $158 now at this point in time, right? Big fall really quickly in regards to Pepsi, and they just report a 9 out of 10 earnings. Folks, their earnings were freaking amazing at Pepsi. I'm talking top line, I'm talking operating income, I'm talking bottom line net income, I'm talking everything, margins, gross margins, everything was freaking good out of Pepsi, really good. It was a 9 out of 10 earnings, and what does that stock get for it? Down 3% here today after it was down again yesterday. What about the generals? Let's check on the generals. There's two generals in the market. One is General Mills. General Mills is now, it's down again here today. It's now down almost about 28.5% year to date. Roughly, General Mills can't find a bottom anywhere. And what about the other general? Dollar General, the massive, we can call it dollar store conglomerate it is, right? It's down 59% now year to date. It was down again here today. 59% year to date. It's hard to fathom these sorts of numbers, folks. For these companies, this is always what they told you that is so safe. And it goes back to, what is really safe, right? What is really safe in the financial markets? They tell retirees, bonds is where you need to be. Well, bonds haven't given you a return in 5 years. 5 years. And have you seen inflation? So inflation's gone up 25 to 30% easily, and those are probably conservative numbers. In the last 5 years, what does inflation hit you with? I would say minimum 25 to 30%, but I could say probably higher than that, okay? Meanwhile, bonds have given you literally nothing for 5 years. So you just lost insane amounts of money in something that was supposed to be so safe. And all these stocks I'm showing you, these are the, if you spoke with a financial advisor and they were trying to tell you about the safest stocks, like these are all the ones, the consumer staple type companies, the brand names. You go to the grocery store, you go this place and that place, and they're everywhere, right? And these sorts of stocks are acting like penny stocks. This is something you would see from a penny stock, honestly. Actually, I know a lot of penny stocks that honestly react better than this. It's insane, right? No, by the way, in regards to Dollar General, they do have, I guess, some good news here, okay? They got the old CEO coming back, okay? They're going to reappoint this guy, Ted Vassos, as CEO, and it's to restore stability and confidence. At the end of the day, what this is supposed to be is our stock price is completely collapsing. We need to do something. We need to make a move here. Now, what I will say about this gentleman, he did do a pretty impressive job when he was there before, okay? He basically oversaw 7,000 new locations for the company between 2015 and 2022. And the company's sales grew about 80% under his watch, we can call it, right? Compared to recently, the company's sales are stagnating, inventories are piling up, and obviously the stock price has just gotten obliterated. Now, how did the stock price do under this gentleman? Well, look at that chart, folks. If you listen to this video, just look at that chart, okay? The stock price under this gentleman went straight to the moon, okay? I mean, it was about a $60 or $70 stock roughly when he took over the company as CEO. By the time he left the company, it's a $200+ stock, right? And then you look at right after he left the company, the stock collapsed. So, I don't know. I mean, that's probably the most, clapping you could possibly do for a CEO. The fact that you skyrocketed the stock price when you were a CEO for 7 years or so, 8 years, and it completely collapsed after you left. So interesting. Now, also, just because he did this in the past does not mean he's going to do it again in the future. So if you think this man's going to come back and the stock price is going to 4x, 5x, whatever, like he did in the past, 3x, whatever, don't quite run to those assumptions. It's a potential, but don't assume what happened in the past is going to happen again and it's all going to replicate itself. Kellanova, which this is supposed to be as the exciting side of Kellogg's business because they split off into two separate companies, WK Kellogg, and then this one, Kellanova. This is like their snack business and stuff. Like, look at this. This stock is down 28.5% this year. It's down again today. Again, every day these stocks are down. Every freaking day. Clorox, bleach, down again today. This stock was $164 on July 30th, okay? July 30th. It's not even mid-October when I'm recording this video, right? It's a $120 stock now. I mean, it's incredible. And when does it bottom? Look at the stock chart. Tell me when that bottoms. Come on, man. It's down in a straight line. It's incredible. Cheesecake Factory, down 4.5% here today, down over 18% year to date. The numbers have been phenomenal out of cake. I mean, you can't say anything bad about the numbers on the margin side, on the revenue side, on the profitability side. I mean, but the stock price just can't get out of its own way right now, right? Texas Roadhouse was $115 on July 16th. It's $91 now, right? That's a crazy drop. We're talking about this is one of the top 10 best stocks in the entire stock market, folks. This is no just average company. This isn't just a creme de la creme in the restaurant space. This is a creme de la creme in the stock market, period. Period. One of the best, most well-run companies in the world. And this stock is just dropping and dropping and dropping and dropping. That's a huge, $24 a share in a matter of, a few months for that type of quality of company is just shocking. RH has just taken a pounding. Look at RH stock. It's down another almost 4.5% here today. It dropped another $10 plus per share. It's down to $238. It was $381 August 27th. It was 6 weeks ago? 7 weeks ago? $381 is $238. And look at the drop. Under 200, is it coming for RH? Probably. Not a guarantee. Probably. I would say probably, under 200 is coming for RH. Now, why would I say that? Two reasons. One is the stock's in complete free fall, so it's not the hardest prediction to make. The second reason is, from what I'm hearing, out of, let's call it the higher end of the real estate market, it's awful. It's dead zone in terms of the high-end luxury real estate market, which is RH's customer base. And so I don't see that fixing itself right now. I think it's going to continue to be bad for at least many months to go in the future, and we could be talking about potentially a year or 2 years. But it's safe to say for at least the next couple quarters, RH's business is not going to be in a good place. They could report much worse sales numbers than they had initially anticipated than what Wall Street's anticipating, and that's just a vicious cycle you have to go through if that's the situation. I think it's very much a potential. Now they're expanding into the European market, and just the European market's not very. You wouldn't really want to expand there right now. Okay, it's not the best timing. And so ultimately, what we're looking at with RH is I think the baby's going under 200. I really do. And then I'll have my attention. But that's what's going on there. PayPal. Oh, you want to talk about obliteration. The stock's now down 26% this year, down another 3% here today. I mean, it's just a dog being a dog is what we call PayPal, okay? I'll give it permission to stay down until first quarter of 2024. I'm done buying the stock in the first quarter of 2024. So until then, stay down, baby. Stay down in Chinatown. I'm a little worried about earnings coming. And when I say worried, I'm actually worried for upside potential for the stock. Because one, it's going to be Chris's first conference call. So I think it's going to be probably a pretty good conference call. My guess is numbers are going to be very, very solid for the company overall. And I think things are going to be looking good. So if anything, I'm expecting the stock to pop on earnings, but I do hope it goes down. Hopefully, the new CEO, Chris, maybe smokes a big fatty before the conference call, preferably from the Planet or preferably from Avant. And that way he's kind of like, I don't really know what I'm doing around here, PayPal. I don't know, what do we do for business again? Maybe, and that could cause a little weakness on the stock. But yeah, I'm not going to hold my breath on that. So I'm trying to add as aggressively as I possibly can with that stock. EL, thank you, baby. Estee Lauder is now under $140 a share. It's now down a shocking 47% year to date for Estee Lauder. Holy smokers, okay? This stock's about as disappointing as the new Six God album. What was that thing, man? Holy smokes. This stock is for all the dogs. Oh, that's all I got to say about that. I can't even wear OVO for this week. I got to take a couple weeks off of wearing OVO clothes after that thing. What in the world happened there? But Estee Lauder stock, a lot of people are wondering what in the world is happening with this stock. The answer is it's obliteration. I will say at least Estee Lauder starting to slow the rate of drop, okay? And so that's that doesn't mean we're at a bottom yet for Estee Lauder. It just means like you're getting closer to that bottom than some of these other stocks that are just still in complete free fall, right? Whirlpool's now down another 3.5+% here today. It's now down over 18% for a year. And keep in mind, Whirlpool, this is 2 straight years of this stock getting slapped. It got slapped last year. It's getting slapped again this year, right? I mean, here's the deal. I think Whirlpool's stock starts to come back in 2024. I don't think their business starts to get in a very good place probably till the second half of 2024, if not the first half of 2025. But I do believe the stock price will probably start, and I have no position in Whirlpool, although it could be a stock I end up buying eventually. But I do think the stock price will likely start coming back in the first half of 2024. And the reason being is a lot of people will view kind of the first half of 2024 as being the trough for real estate and then things starting to get better. And when I say better, I don't necessarily mean prices going up. I just mean activity, volumes getting moving in the second half of 2024 and then especially into 2025 because we're just kind of in this stalemate market and we're going to continue to be in the stalemate non-movement market here for a bit in regards to this, right? Look at this, folks. Look at the housing stocks here today. Oh my gosh, you want to talk about wrecked. Look at that. D.R. Horton down almost 6% here today. Toll Brothers down 5.77% here today. Redfin is down 5% plus here today. By the way, check out Redfin year to date. Check out Redfin on a 2-year. Oh, baby. KB Home down 5.5% here today. Lennar down over 5%. Pulte Home down 5%. Finally, maybe some reality is starting to come in in regards to these home builders. Like they've been a lot of these stocks hit all-time highs recently, and I'm just like, I don't know what's going on. Like you guys got to, Wall Street's got to be aware of the potential housing huge problem. The home builders just sent the Federal Reserve, along with the National Association of Realtors, mortgage bankers, folks, right? They'll just sent the Federal Reserve basically a letter begging them not to raise rates anymore. Why do they do that? Because they're probably looking at volumes that they're like, oh my gosh, it is going to be a horrible fall. It's going to be an awful winter. And if it's an awful winter, you could be potentially talking about a bad spring selling season. If it's a bad spring selling season, you lost everything as a home builder, okay? Because you already know winter is going to be weak no matter what, because a lot of people don't like to go shopping for a new home in wintertime. But when you talk about what people are going to be facing for mortgage rates this winter, high 7s, maybe low 8s, that's brutal, man. Absolutely brutal. So housing stocks, they're getting hit. In that, hedging, hedging, okay? I obviously Toll Brothers is one of my hedges for this upcoming year, and it's off to a good start. We're already up 32% on this one, up about $1,983. I think Fidelity's a little conservative with these numbers. If I actually sold these puts today, these 7 contracts, I bet I could get more money than what Fidelity has here. But anyways, nonetheless, that's off to a good start. Polaris, one of my other puts, that's looking pretty darn good. Polaris sells a lot of those ATVs and all that fun recreational equipment, and just this is not the market for these sorts of things. Okay, a lot of those are bought on loans. And with the way interest rates have gone up, anything big ticket, like, it's just not going to be the play. And Polaris is just one of those many things that's just not the play right now. And especially with the way inflation has sliced and diced in middle class. Because keep in mind, a lot of people that buy these fun toys, a lot of people in the middle class, folks. A lot of people, make $50,000 to $100,000 a year. That's who buys a lot of these different things. Okay, Chipotle, one of my other hedges. We'll see how this one obviously turns out. It started out decent here. We're about 5% on it so far, but we'll see. Chipotle's going up on price. We'll see if their customer base accepts that new price increase, because we're in a different environment. Last time Chipotle was really raising price, the consumer was in a lot better spot. They're about to raise price again, and the consumer's not in as good of a spot. So we'll see, how customers end up taking that. Apple's the one that's, I need Apple down, man. Apple continues to hold strong, and I'm like, just give up Apple. Just throw in the cards. Like, come on, man. So that's the one hedges that, are just not doing it right now, is really the Apple. I mean, you look at big tech today, and with all that slaughterhouse I just showed you, all those consumer staples, all those brand name companies, down 4 and 3 and 5% and down 30% year to date, 40s and 50s and 60% year to date. And then you go to Apple, it was green today. Palo Alto Networks, green today. Adobe, green today. AMD, green today. Amazon, green today. Amazing's on green. Oh gosh, it goes back to the playbook of what this year has been, right? Which this year has been a playbook of these sorts of stocks. Now, does it continue next year? I'm not so sure about that. But it certainly has been the playbook of this year, right? So it's just what we have going on. People are looking for places to hide, right? And last year, it's funny. Last year, everybody wanted to hide in consumer staples. That was the thing. That was the playbook last year. Dividend stocks. My dividend portfolio held up tremendously well last year, right? In dividend stocks in general, it was the year of dividend stocks. Their outperformance versus the Apples and the Microsofts and the Metas and the Teslas and the Shopifys. Oh my gosh, it was night and day difference, because those stocks got slaughtered. A lot of the dividend related stocks actually went up last year, or at least held pretty strong, right, with small drops. And this year, it's a 180-degree difference, right? It's like all these tech stocks are just holding so strong and have had an amazing year, and these dividend stocks are just falling knives that people are like, when does it end? When does it end? And we'll see. I think this upcoming week's a very important week, and the reason it's such an important week for a lot of these stocks I just went through that are getting slaughtered, that are falling knives, is this is the same time of year. Basically, the market bottomed around, for almost all stocks, especially all these tech stocks, between basically the middle of October through the beginning of November. And so that's why this next few weeks is an important because if we don't see a bottom in these dividend stocks, basically over the next 3 weeks, that's going to be even scarier, because then people are going to be like, oh, that bottom we got in the tech stocks last year is not happening in dividend stocks. And then where do we go from there? Do we get a Santa Claus rally? If not, then, oh man, that's rough. This one, I'll put it this way. It pisses me off, okay? McDonald's. I called it Mick overvalued since, going into this year. I called it Mick overvalued. And the stock went up at the beginning of this year, obviously. And I looked at it and I'm like, okay, it was already Mick overvalued going into this year. It's more Mick overvalued than ever before now. And I'm just disappointed in myself because I didn't hedge against this one. I should have been buying puts. I had several months, basically all the way from about April through, August. I could have hedged against this one, probably in the $290 to $300 range. And I just didn't do it. Now the stock's sitting at $246. And I'm just upset with myself. I'll just say that. I'm upset with myself. I should have hedged against this one. I thought it was an easy hedge even going into this year. And then had that blow off top. Ugh. But anyways, it is what it is. 3M, I was checking out 3M here today, folks. Is down another 1.5% here today. It's down 53% now at this point in time. In the past 5 years, okay? In the past 5 years, it's just been a brutal 5-year period for 3M. And it's just, Yeah, this is another one of those. It's like, where does it bottom? Where does it bottom? The good news for 3M is they're getting through a lot of their legal matters, which has been the big hang up for 3M. So ultimately, that should help them in the future, but you can't get too confident in that, right? You know what I call this watch list. I call it the slaughterhouse, okay? This is a Fintech watch list, and it's October, and this is a slaughterhouse, okay? And that's exactly what it was today, okay? Affirm was down 7.6%. Rocket was down 4.5%. Hood was down 4.4%. Rocket's another one of those that likely bottoms in the first half of 24 as well, right? Hood, is that one going to go back to the 8s? We'll see. Upstart down over 4+%. Obviously, we talked about PayPal got hit nearly 3% here today. Coinbase got hit nearly 3%. Square was down 2.5%. SoFi was down 2.3%. I mean, these stocks are just a slaughterhouse. They can't do anything right. I do believe these stocks bottom in the first half of 24, but for now, they just remain in this horrible, horrible period. Horrible period. The thing is with these businesses, though, they're all so different. They're all so different. Like some of these companies are extremely unprofitable. Other ones are extremely profitable, a la PayPal, right? Some of them have horrible business models here going on, like a Rocket, for instance. Business model is awful right now because there's so few mortgages and refinancing going on, right? Their business is trash. On the flip side, PayPal, you look at their numbers and they're freaking amazing on a non-GAAP basis and a GAAP basis. So you just have divergences, differences in these business models, and we'll see who the winners and losers are over this next couple of years. I think I know who's going to be the winner and losers of that bunch, okay? WBA. Are we looking at a stock, folks, that is finally getting their stuff together? We might be, okay? WBA stock has had the toughest multi-years it's ever had, and certainly the toughest it's had since the great financial crisis, right? Stock was up over 7% here today. It's finally coming back to life, okay? Now, the two big things just happened for WBA that is going to be very, very bullish. I mean, extremely bullish for this company, okay? So the first one is they're bringing in essentially Tim Wentworth, who's going to be the new CEO of the company. They kicked out, obviously, Roz Brewer. Now, this gentleman has some phenomenal experience in the industry, specific. He used to be the CEO of Express Scripts, which was a very successful company. Like, look at Express Scripts stock price, over time. Like, that was a phenomenal company, very well run. I would say one of the most well run, certainly in the healthcare space. And so he did a hell of a job. Now, it doesn't mean automatically he's going to do a hell of a job at Walgreens, but Wall Street definitely likes him being here. Okay, he definitely in Roz Brewer. I mean, just. It's so disappointing because she was like a first-round pick. It wasn't like Roz Brewer was some, nobody. When Walgreens picked her up to be the CEO, she was a former COO of Starbucks. She's a former CEO of Sam's Club, which is owned by Walmart. And I mean, you just thought like she was a first-round pick, and she just ended up being a bust. She ran this company for 2.5 years and just didn't make the progress she needed to make. 2.5 years, and eventually you have to kind of give up on it, and that's obviously what happened with the board of directors. They gave up on Roz Brewer, and it's just crazy, man, crazy. Just a first round bust. That's all Roz Brewer was. Now, I can honestly see in these most recent results here, I can see why she got canned. Just to put it quite frank. First off, the sales growth is phenomenal, 9.2%. Freaking for Walgreens, like 9% revenue growth, you'll take that any day of the week, okay? But the problem is Walgreens is not a revenue growth company. Walgreens needs to be a profit growth company, a net income growth company, an EPS growth company, okay? That's why people buy Walgreens stock, not for growth. They buy it for the dividend. They buy it for that profitability, that cash flow. Well, on an adjusted basis, you want to look at the adjusted numbers for Walgreens because they basically have a bunch of one-time legal fees that went into a whole bunch of crap, okay? So adjusted net earnings came in at $575 million. Adjusted EPS came in at 67 cents. Those are both down about 17% year over year. You can't have that. You can't have that. You can't have your revenue up 9+% and your adjusted net earnings and EPS be down that much. At some point, somebody's head's got to roll. And the head that's going to roll is Roz Brewer, who was the CEO of this company. And she got canned, and that's that. And hopefully the new gentleman does a lot better. The good news is he is from the industry, whereas Roz Brewer came over from Starbucks to come run a pharmacy chain, right? So a little different here. So anyways, now, I saw this and I was like, oh my gosh, they're taking shots at Roz Brewer. They really are. In the first couple of sentences here, this is a new interim CEO, not the new CEO, Tim. This is just a woman that took over. She says, our performance this year has not reflected WBA's strong assets, brand legacy, and our commitment to our customers and patients. I agree. But that's basically shots at the CEO saying, you were doing a crap job running this business and it's not reflected. And then she goes on to say this. In just 6 weeks, basically the time Roz Brewer's been gone, we have taken a number of steps to align our cost structure and our business performance, including planned cost reductions of at least $1 billion and lowered capital expenditures by approximately $600 million. We anticipate these impacts in these actions in fiscal 2024, beginning in the second quarter. So the bottom line is there's several shots taken right off the bat at basically Roz Brewer saying, you did a crap job running this company and, you deserve it, you can. She got a big pay package, man. Big pay package. And I got to be honest, I don't know how much she did, to be honest. As she had 2.5 years there, and I'm just like, didn't seem like she changed that much. In 2.5 years, it's a long time. And she had like a good warm-up period. Like from the time they announced Roz Brewer was going to be CEO, there was like a good time period there for her to study up on the company, get to know everything, and to still get 2.5 years and just not. I will say it was pretty big disappointment, but that's a problem with investing in public companies. You get into some of these companies and sometimes the CEOs do a hell of a job. They do the best job you could ever imagine. And sometimes they do an absolute crap job. And that's just the risk. And that's what staying diversified pays off huge, right? Now, I bought some stocks here today. What did I buy? Well, I bought 3 stocks, okay? I bought PayPal, I bought Cheesecake Factory, and I bought Texas Roadhouse here today, right? PayPal, still big focus for me right now. Got to continue to build this one as rapidly as I possibly can. Yeah, I got to build that one rapid. Okay, rapid. Cheesecake Factory, continue to add to that one. I love the valuation on cake right now. Arguably the most well-run restaurant chain in the United States of America. Really the only one you could argue with is Texas Roadhouse. It's really between them and Texas Roadhouse. I think Texas Roadhouse takes the cake, no pun intended, in regards to the most well-run restaurant chain in the United States of America. But both those are just, I got to, cake and Texas Roadhouse, I'm not working with as much, so I'm buying Texas Roadhouse, I'm buying Cheesecake Factory, and I'm, buying those stocks along with many other stocks, but I'm not working with as much urgency as I am with PayPal. PayPal, I'm much more worried and scared it's going to start going up very soon. I'm much more worried about that one starting to go up fast than I'm worried about Cheesecake and Texas Roadhouse, because I don't think the worries around the consumer necessarily go away, but I am very concerned about when Alex Chriss, the new CEO of PayPal, starts to tell his story on, how they're going to improve this and that and tweak a few things here and there. And I'm very concerned that stock could, let's just call it, start to perform very, very well very soon. Whereas Cheesecake and Texas, I'm not as concerned, okay? So anyways, those are stocks I bought here today. Now, the question is, will I be buying stocks tomorrow? And the answer to that is, tomorrow, I will be buying stocks tomorrow. And if you want to see what moves I'm making out there, join my Patreon. That will be pinned comment down there. You get to see the stocks I'll be buying tomorrow. I might be buying a brand new stock tomorrow in the portfolio. So in regards to that, you get to see not only the stocks I'm buying and selling, but you get to see exactly how I build out a portfolio, which is just a great piece to learn from, exactly how I do it, the hedges I have, like how I balance out the portfolio over time, how how big I make positions versus, let's call it smaller positions. Like you get to see all that literally being built right in front of you. And I think it's one of the most valuable learning pieces you could ever imagine. So make sure you get in there, guys. It's super cheap. It's a pinned comment down there. And other than that, folks, thank you for being subscribed. We got a fun market now. Earnings season's here. Much love and have a great day.